the New York Stock Exchange. A place where so many have tried to grab the bull by the horns, only to get trampled by its unforgiving hooves. The city that never sleeps, where complex algorithms run trades at fractions of a second, pulling in billions for those wielding its power. And who's wielding the power? Well, you already know. On the quest to make gains, so many have watched their cash burn up in flames as their accounts are blown up and left deep in the red. So who would be dumb enough to fight such an unwinnable battle? Who would take on a giant knowing they're not going to win? Hey guys, it's Goose, and welcome to my channel. I've been trading for a few years now, but it's not saying much. When it comes to trading, I'm like the Cleveland Browns. A few bad investments, bad picks, and haven't had a winning season in years. On a spectrum of investors, and I do mean spectrum, I'm as regarded as they come. Let me explain. Let's review the spectrum of investors. On the left, we have the worst type of investor. The people that watch their money turn to ash as they bought Beanie Babies thinking it was a sound investment. And on the right, we have Warren Buffett, the best type of investor, who has amassed billions running one of the most successful holding companies in the world. And I'm right about here. On this channel, I'll be breaking down some of my trades in the hopes that you learn from my fails. And when I get a win, eventually, I'll break it down also. So with all that said, I'm going to start off with one of my more recent trades that has gone against me. A covered call I sold on my 100 shares of Gap. But before I continue, there are so many YouTube videos that can break down a covered call way better than I can. So if you're interested in learning more, I recommend In the Money Adam, Kamikaze Cash, or Pandrea Finance. Alright, now let me give you my poor breakdown of what I understand a covered call to be. First, what is a call? A call represents the right to buy 100 shares at a set price. This set price is known as the strike price, or strike as it's known in the streets. However, you are not obligated to actually purchase these shares. You can buy these in most brokerage accounts under the options tab. When you buy this, you pay what's called a premium, which is the price of the call. If you buy a call, you are buying to open a trade. If the share price rises above your strike, your call gains value. The higher the rise, the more value. With this call, you lock in the price you could pay for the shares, which is the strike times 100. So if you buy a call at the $20 strike on a stock that goes to $25, you can still buy the 100 shares at $20. Or you can sell the call for profit and the trade is done. But that's not what I did. I sold the call against my 100 shares, which makes it a covered call. Now the opposite takes place. When you sell to open a call, you're agreeing to sell shares at the strike price of your choosing. As you sell, you collect premium. At expiration of the call, if the share price is below the strike, you keep your shares and all of the premium. You can close before expiration if you're at a profit also. The trade-off in selling the call is you agree to sell the shares at an agreed on price. So even if the stock flies, you still have to sell them at that strike price. So let's break down my trade. I sold one covered call on my 100 shares of Gap at the $22 strike price. For an exchange of premium, I was given $287 through the brokerage paid for by another trader out there in the ether. I chose to sell a longer dated call to collect some easy premium and it went against me really quick. I bought the shares here and sold the call soon after, and the stock kept going up. And that's fine. I'm fine, I swear. The reason I'm okay with it is Gap pays a dividend of nearly 17 cents a share, so every quarter that I hold, I will receive $17. The call expires in roughly 5 months, so I'll collect the January and April dividends. As we approach the expiration date of the contract, more time value is eaten from the contract, which works in my favor. When we get to expiration, I will see if I can close the trade by buying back the contract. If I don't, my shares will get called away, which means I will lose my shares, but I will receive the cash value of 100 shares sold at the $22 strike price, for a total of $2,200. So overall, it's not the best trade, and I'm going to have to do some managing. In the past, I would have bought back the contract at a loss, which means I would have had to pay back not only the premium, but whatever extra amount needed to close the trade. So that's the trade in a nutshell, but if I were to do it again, this is what I would do differently. I would have waited for the stock to go up to a resistance level, so if it dropped from there, I could close it for profit sooner. I would have also selected a higher strike price to capture some upward price movement. I would have set a sell limit also. It's like leaving a hook out there to catch some fish. And what I mean by that is I could have set a sell limit that I was comfortable with that would have netted me more premium. I didn't apply patience and now I'm paying for it. But you live and you learn.